The date, Monday, June 23, 2025. A seemingly ordinary day on the calendar, but one that would soon be etched in the annals of financial history. As the sun began its ascent across the globe, casting light on bustling cities and quiet towns alike, little did the world know that a storm was brewing, a tempest that would soon engulf the global markets in a maelstrom of uncertainty and fear. The news wires were humming with anticipation, unaware of the impending shockwave. Then the unthinkable happened. The world awoke to a seismic event, a jolt that reverberated through every corner of the global financial system. The breaking news flashed across screens. The United States had launched targeted airstrikes on Iran's nuclear facilities. The rationale, according to official statements, was to prevent the imminent development of nuclear weapons, a move deemed necessary to safeguard global security. But the consequences, as the world would soon discover, were far-reaching and devastating. The carefully constructed edifice of international relations was teetering on the brink. The impact was immediate, visceral, and undeniable. Stock markets from Tokyo to Sydney plunged into a sea of red as investors scrambled to make sense of the unfolding crisis. Billions of dollars were wiped out in a matter of minutes as the initial shock gave way to widespread panic. The carefully calculated portfolios of seasoned investors were decimated, and the savings of ordinary citizens evaporated before their eyes. Fear swept through the Asia-Pacific financial centers like a wildfire, consuming everything in its path. Seasoned traders, hardened by years of market volatility, watched in disbelief as their screens flashed a relentless stream of negative numbers. The air was thick with tension, the silence punctuated only by the frantic tapping of keyboards and the hushed whispers of disbelief. Red dominated trading screens, a stark visual representation of the financial carnage unfolding across the region. This signaled a sharp downturn and a wave of uncertainty that threatened to engulf the entire global economy. The charts painted a grim picture with lines plummeting downwards in a seemingly endless descent. Volatility spiked to unprecedented levels as investors braced themselves for further shocks. This wasn't just about numbers on a screen. It was about livelihoods, about the hopes and dreams of millions of people whose financial security was now hanging precariously in the balance. Factory workers in South Korea, small business owners in Australia, and countless others across the region watched with growing anxiety as the news unfolded. They were all suddenly at risk, their jobs, their savings, their futures, all threatened by a conflict thousands of miles away. The Asia-Pacific, a region heavily reliant on stable energy supplies and seamless trade routes, found itself teetering on the edge of a precipice. It now faced the looming threat of a wider conflict, a conflagration that could potentially engulf the entire region and beyond. Boardrooms and trading floors, the nerve centers of global finance, abruptly shifted their focus from the pursuit of profits to the grim specter of war and its potentially catastrophic consequences. The interconnectedness of the global economy was laid bare for all to see, a stark reminder of how deeply intertwined the fates of nations had become. A single military strike in the volatile Middle East had triggered a wave of financial pain that rippled across continents, leaving a trail of devastation in its wake. Major market indices like Japan's Nikkei, South Korea's Kospi, and Australia's ASX 200 all tumbled precipitously, erasing billions in market capitalization. This reflected the pervasive sense of investor anxiety, a deep-seated fear that the worst was yet to come. The world watched with bated breath, bracing for the full economic fallout of this new and dangerous conflict, a conflict that threatened to plunge the global economy into a period of prolonged instability and uncertainty. The market shock began the night before as the U.S. launched Operation Midnight Hammer, precision strikes on Iran's Fordow, Natanz, and Isfahan nuclear sites. The mission, using advanced stealth bombers and bunker-busting bombs, aimed to cripple Iran's nuclear ambitions. But rhetoric from Washington hinted at regime change, escalating fears of a broader conflict. Iran's leaders condemned the attack, vowing retaliation and closing the door on diplomacy. The world now faced not just destroyed facilities, but the real risk of a spiraling regional war. As Asian markets opened, the reaction was swift and severe. Japan's Nikkei 225 dropped sharply, erasing billions in value. South Korea's Kospi and Australia's ASX 200 followed suit, each falling nearly 0.5%. These declines, though seemingly modest, represented a synchronized vote of no confidence from investors. The sell-off was broad, hitting technology, manufacturing, banking, and retail. The message was clear. The economic shockwaves from the Middle East would not be contained. A conflict in Iran was now everyone's problem. Whenever the Middle East erupts in turmoil, the world holds its breath. The region's volatility has a direct and immediate impact on global energy markets, and by extension, on economies worldwide. It's a stark reminder of our interconnectedness and dependence on this critical region. Oil prices surge, and this time was no exception. The slightest hint of instability sends shock waves through the market, triggering a flurry of activity and speculation. This isn't just about numbers on a screen, it's about the real-world impact on businesses and consumers. Brent crude, a global benchmark, jumped over 1% to $74.33 a barrel, reflecting the immediate anxiety in the market. Traders and analysts closely monitor these fluctuations, understanding that even small changes can have significant ripple effects. As traders feared supply disruptions from the world's energy heartland, the fear isn't unfounded. Any disruption to the flow of oil from this region can create a domino effect, impacting supply chains and driving up prices across the board. The Strait of Hormuz, a vital oil artery through which a significant portion of the world's oil supply passes, was suddenly at risk. Its strategic importance cannot be overstated, and any threat to its stability sends shivers down the spines of energy planners worldwide. Even the threat of conflict, without any actual disruption, could choke off global supply, creating artificial scarcity and driving up prices based on speculation and uncertainty. The mere possibility is enough to trigger market reactions, sending prices higher. This immediate price increase reflects not just current supply and demand, but also the anticipated future impact of potential disruptions. This fear premium rippled through markets, creating volatility and uncertainty across various sectors. Investors become wary, and markets react to the perceived risk, often leading to sell-offs and declines. As buyers scrambled to secure energy supplies, hedging against potential future shortages and price increases. This rush to secure resources further exacerbates the price surge, creating a self-fulfilling prophecy. For oil-importing nations, the spike meant higher costs for transport, as fuel surcharges and increased shipping rates added to the burden. This directly impacts the cost of goods and services, ultimately affecting consumers. Manufacturing and electricity generation, as businesses face increased energy expenses. These costs are often passed on to consumers, contributing to inflation and potentially slowing down economic growth. The price surge was the most immediate and visible economic consequence of the strikes, highlighting the vulnerability of the global economy to disruptions in the energy sector. Asia-Pacific economies, heavily reliant on imported oil, felt the pain instantly, with stock markets reacting negatively and businesses facing increased operational costs. The region's economic outlook becomes more uncertain in the face of rising energy prices. For the dynamic economies of Asia-Pacific nations, the price of oil isn't just another data point. It's a critical determinant of economic health and stability. The region's reliance on imported energy makes it particularly susceptible to fluctuations in the global oil market. Soaring oil prices are not just an inconvenience. They represent a direct and immediate threat to economic growth across the region. These price increases ripple through various sectors, impacting everything from manufacturing to transportation. Consider economic powerhouses like Japan and South Korea, as well as the rapidly growing economies of China and India. All major energy importers depend heavily on a steady supply of affordable oil to fuel their economic engines. These nations have built their industrial might on the back of readily available and relatively inexpensive energy. Affordable oil is essential to power their industries, keeping factories running, supply chains moving, and goods flowing both domestically and internationally. A sudden price hike in oil prices places immense strain on national budgets, forcing governments to reallocate resources and potentially cut back on essential public services. It also directly squeezes company profits, as businesses struggle to absorb higher energy costs, impacting their bottom lines and potentially leading to reduced investment and hiring. Ultimately, these increased costs are passed on to consumers, raising consumer prices across the board. Higher fuel costs inevitably translate to broader inflation, eroding the value of savings and wages. This shrinks the purchasing power of ordinary people, making it harder for families to afford basic necessities and maintain their living standards. In response, governments face a tough choice. They can raise interest rates to try and combat inflation, a move that can cool down the economy. but this risks triggering an economic slowdown or even a recession, as higher borrowing costs can stifle investment and growth. Despite ongoing efforts to diversify energy sources and invest in renewable energy, Asia's economic fortunes remain inextricably tied to the political and economic stability of the Middle East, the world's primary oil-producing region. The latest sudden spike in oil prices has once again exposed this underlying vulnerability, highlighting the precarious position many Asian economies find themselves in. This explains the swift and often dramatic reaction observed in Asian stock markets whenever there's a significant movement in global oil prices. Even the potential for a crisis in the Persian Gulf demonstrates how easily Asia's economies can still be held hostage by events unfolding thousands of miles away, underscoring the urgent need for greater energy, independence, and diversification. In crisis, fear drives investors to seek safety. Risky assets like stocks are dumped, especially in sectors exposed to energy and trade shocks. Safe havens, U.S. government bonds, gold, and stable currencies become the new favorites. Airlines, manufacturers, and shippers were hit hardest, but the sell-off spread across entire markets. The flight to safety isn't about company fundamentals, it's about survival. Investors accept lower returns for the security of their capital. The U.S. strikes triggered a global portfolio shift overnight. Markets dropped not from weakness, but from a sudden collective fear. The world's financial system braced for more turbulence. Financial experts and officials scrambled to interpret the chaos. A Hong Kong strategist summed it up: "Markets hate uncertainty, and right now, we have no clarity." The specter of regime change, not just targeted strikes, terrified investors. Japan's government urged restraint, highlighting its dependence on Middle East energy. Analysts explained the oil price surge. It's not just about lost barrels, but the risk to vital shipping routes. The Strait of Hormuz became the world's most watched choke point. Wealth managers advised calm, but acknowledged fear was driving decisions. The market's reaction was a rational response to a world suddenly on edge. The impact of the strikes will ripple far beyond trading floors. Companies may freeze investments, delay hiring, and brace for higher costs. Consumers will feel it at the pump and in rising prices for everyday goods. Inflation will squeeze household budgets, slowing spending and growth. Governments face tough choices: subsidize fuel, raise interest rates, or risk political backlash. Central banks must balance fighting inflation with supporting fragile economies. The crisis will force Asia to rethink energy security and trade routes. Once again, global prosperity is hostage to geopolitical conflict. As the dust settles, the big question is, what comes next? Iran's response, military, cyber, or economic, will shape the region's fate. The U.S. and its allies must decide whether to escalate or seek diplomacy. Markets will remain volatile, with oil prices elevated and investors wary. Any sign of de-escalation could spark relief, but confidence won't return quickly. The Asia-Pacific's economic destiny now hangs on events far beyond its control. The world watches, knowing the next move could mean recovery or a prolonged crisis.